Think about this. China has historically been Nvidia's #2 global market. There are $0 in the forecast coming from China. None. Not a dollar.
They use those words, largely conceded. Well, the market to Huawei
today, but things change. And
I don't know. They didn't change. He went over there. Jensen was literally, feet on the ground with the president of the United States and came home and then days later says they've largely conceded the market.
Understood. I don't think that you respect Jensen's gangster enough, because we've had conversations on the show that Apple would be ejected from China. Hasn't happened. Apple's China sales out of nowhere became a bright spot. We heard Tesla would never survive.
Yeah, but Apple already had 20% of its revenues coming from. Nvidia hasn't had anywhere near that degree of business coming from.
In the last 5 years, no. But historically, China has been a huge market for GPUs. And I don't think we should just say, because there's nothing in the forecast now, there never will be.
Well, 8 companies are allowed to buy them. Remember, Jensen went on that trip with Trump last week. No one's actually purchased. No purchase orders.
There are approved buyers now. That is something that
China's what's holding back. But more
there were approved buyers before. We just learned more specifics about who could buy. Yeah. We had already approved the buys.
Yeah, I don't think
know who the buyers
I don't put 2, no number 3. It is number 1.
There's no competition here. Part of the issue for why the stock isn't doing all that much, there's competition in China.
That's true.
And they're largely conceding that, as they said. Okay, so if you don't have any visibility into business in China, that you're just not going to get any, like what you maybe thought or investors were hoping for. Does that change the story
at all?
What
if that's the catalyst?
But now they're also turning into the debt markets as well. So I think markets are just digesting the fact that we're seeing some leverage amongst these hyperscalers as well.
Yeah, and look, it's not the only one doing that. I mean, look, Alphabet did it last week. I mean, it's tapping the equity market right now. We've just heard Nvidia is also doing that, according to the folks over at Bloomberg as well. And you just wonder, with so much free cash flow on hand, as you say, why they need to be obviously going and raising more money here. But look, I hear what you're saying about obviously the huge capex. It was kind of like hold my beer, Google, when they came out with that figure at the start of 2026. And also the portfolio repositioning, as we have seen that reallocation into, away from the big spenders, I should say, into more of the bottleneck sort of parts of this market as well. I just want to talk about your particular rating on this with a strong buy and a $325 price target. What gets us there?
Yeah, no, it's fairly simple. I mean, Amazon, the whole thesis behind our strong buy rating is that Amazon is a mix shift story, meaning this is a company that's generating, nearly $800 billion in annual revenues. Their operating margins today are around 12%. 2 years ago, it was half that, around 6%. And the sky's the limit for Amazon's margins over the long term. And I say that because the fastest growing businesses for Amazon are also its most profitable businesses, namely AWS and ads. And their least profitable business is the retail business, and that's growing slower than ads and AWS. And so that's why we really like the story behind Amazon here is that, like I said, operating margins right now are around 12%. Within the next 5 years or so, we can probably hit closer to 20%, maybe even higher over the longer term. And when you're a company that's close to generating $1 trillion in annual revenues, that's going to trickle down to some sizable EPS growth.
Obviously, there's a lot of analysts out there, investors who like the AWS growth story. But what is the most important story that you're keeping an eye on this year? Particularly when you think about its partnerships with some of the AI companies, and also, of course, what it's doing with respect to groceries and that strategy as well.
Yeah, I mean, I think another important thing for Amazon is that us analysts are really looking at the 3 pillars of Amazon's growth. That's the retail business, that's the ad business, and that's the AWS business. And obviously, most of the focus is on the AWS side of things, and rightfully so, given how much growth there is right now. AWS growth in the latest quarter was 28%. Within a year, it's probably going to be in the mid 30% range. Within a year and a half, we could see over 40% AWS growth, just given how much money this company is investing in that business. But we're also overlooking some of the other, I would say, other bets at Amazon. Grocery is a huge bet that they're undertaking as well. Healthcare is another area that Amazon is betting on, and then also and this is probably one of the more underappreciated pieces, is the telecommunication side of things. Amazon Leo, which is a direct competitor to Starlink. We talk a lot about SpaceX and what's happening there right now, but Amazon Leo is I believe a formidable competitor to Starlink, and they're just getting started in that space. And I will tell you right now that most sell side analysts are not modeling the growth potential at Amazon Leo, in the grocery business, in the healthcare businesses. These are all, I think, incremental upside to the stock.
Okay, so looking at areas that are perhaps underpriced by the rest of the street. Arun, really appreciate it. We're going to wrap it up there, but thanks for getting us across your thoughts today. Arun Sundarundam, who's the Senior Vice President of Equity Research over at CFRA. Let's trade Amazon now with Tom White, host of Fast Market. Tom, as Arun said there, I mean, this is less about the growth story, the fact that it's come off. I mean, this is largely as he thinks about sort of portfolio repositioning, moving it into other parts of the market, but also just maybe some of the concerns that it's tapping the debt market to fuel all the capex. Just walk us through an example.
Why memory stocks suddenly crashed before Micron earnings? Before Micron reported earnings, AI-related semiconductor stocks experienced a sharp sell-off. At first glance, many investors assumed something had fundamentally changed, but that wasn't really the case. The selling actually began overnight in the South Korea. The KOSPI index fell nearly 10% and triggering heavy selling across the memory stocks, specifically SK Hynix and Samsung, two of the world's largest memory manufacturers. Several factors came together. Reports suggested that SK Hynix was temporarily prioritizing the production of higher margin general purpose DRAM instead of accelerating some HBM4 production line. Some investors immediately interpreted that as weaker demand for Nvidia next generation Rubin platform. But that's not what the report actually implied. If anything, it suggested that memory demand is so constant that manufacturers are allocating production toward whichever product generates the higher returns. That's the supply issue, not a demand issue. At the same time, South Korea stock market had become heavily leveraged. Margin debts has reached the record levels, and regulators warn that semiconductor related ETFs has become overheated. When investors began taking the profit, leverage selling accelerated the decline across the entire market. The result was panic selling in the memory stock worldwide. Did AI demand suddenly slow? That's the question everyone started asking. The answer, based on virtually every industry data point available today, appeared to be answer is no. Multiple analysts covering Taiwan and Korea said their supply chain check still now AI demand is accelerating. Several factors describe the current environment as roughly 50 units of demand for every 1 unit of available supply. Even companies that are building billions of dollars of new manufacturing capacity still cannot keep up with the demand. That's why prices remain elevated, and that's why margins remain expanding, and that's why companies like Micron are signing multi-year customer agreement. The real debate isn't the whether demand is it. Everyone agrees that demand is enormous. The real question is how long can this last? Historically, memory has always been one of the most cycling industries in the technology. When prices become attractive, manufacturers expanded the production. Supply eventually caused the demand and price collapsed. Margin disappeared and investors who bought near the top often suffered. That's why memory companies traditionally traded at a very low valuation multiples. Today, however, many investors believe this cycle is fundamentally different. Instead of consumer electronics driving the demand, artificial intelligence has become the dominant customers. Every new AI models require more memory, and every new GPU generation require more HBM. Inference's workload continue expanding, and agentic AI require larger memory pools. Physical AI and humanoid robots could increase memory and demand for even further. If that's true, then today's demand for memory cycle could be last far longer than previous cycle.